Okay, now let's continue with the equity investments and reporting methods under PFRS. The table provides the decision rules to be followed to classify equity investments and the method of their reporting under PFRS. In the following sections, we will illustrate both consolidation and equity reporting. So we have sole control, if yes, subsidiary structured entity, consolidate following Pfrs 10 and disclose following Pfrs 12. If no, is there joint control? If no, significant influence? No. Joint control, if yes, rights over individual assets and liabilities of joint arrangement. If no, joint venture. For yes, then there will be joint operation, report share of assets, liabilities, and revenues and expenses, and disclose following PFRS 12. Then if no, joint venture, it's report using the equity method following PAS 28 and disclose following PFRS 12. Significant influence, if yes, then it's an associate. Report using the equity method and disclose following PFRS 12. If no, passive investment, report as fair value through profit or loss or through other comprehensive income following PFRS 9. Okay, so we have now your uh, table for equity investments and reporting methods. As we review consolidation, it's crucial to understand that reporting is not the same as recording. Consolidated amounts never appear on the parent company's book. Reported numbers are the results of spreadsheet analysis, either computer-based or manual. Controlled entities, there are many aspects of control that accountants must be aware of. The two general types of control entities are subsidiaries and structured entities. So variable interest entity, uh, a variable interest equity, this will be discussed on the later part of this chapter. Subsidiaries, by far the most common type of controlled entity is subsidiary, a corporation or an unincorporated entity such as a partnership or trust company that is controlled by a parent company that owns usually a majority of the voting shares or rights of the subsidiary. Since stockholders elect a corporation's board of directors holding most of the shares, enables the parent company to control the composition of the subsidiaries board. The concept of control. Consolidation is the process of combining the assets, liabilities, earnings, and cash flows of a parent and its subsidiaries as if they were one economic entity. A parent is an entity that controls one or more subsidiaries. A group is a parent and all its subsidiaries. PFRS 10 Guidance on Control. An investor determines whether it's a parent by assessing or it controls one or more investees. PFRS 10 uses control as a single basis for consolidation. An investor controls an investee if and only if the investor has all of the following three elements of control. So we have now number one, power over the investee. Power is the ability to direct those activities which significantly affect the investee's returns. It arises from rights. which may be straightforward, such as through voting rights, or complex, such as through one or more contractual arrangements. 2. Exposure or rights to variable returns from involvement with the investee. Returns must have the potential to vary as a result of the investee's performance and can be positive, negative, or both. The ability to use power over the investee to affect the amount of the investor's returns. Power arises from rights. Such rights can be straightforward, such as through voting rights. An investor that holds only protective rights cannot have power over an investee and so cannot control an investee. Cannot control an investee. Power can be obtained directly from ownership of the majority of the voting rights, or can be derived from other rights such as rights to appoint, reassign, or remove key management personnel who can direct the relevant activities, rights to appoint or remove another entity that direct the relevant activities. And we have rights to direct the investee to enter into or veto changes to transactions for the benefit of the investor, and other rights such as those specified in a management contract. When assessing whether control exists, an investor with decision-making rights should establish whether it is acting as a principal or agent of other parties. An investor that is an agent does not control an investee when it exercises a decision-making rights delegated to it. A number of factors are considered in making this assessment. For instance, the remuneration of the decision maker is considered in determining whether it is an agent. Control as the criterion for consolidation. Subsidiary is defined as an entity that is controlled by another entity, the parent. Control is the criterion for identifying a parent-subsidiary relationship and the basis for consolidation. The determination of whether one entity controls another is then crucial to the determination of which entities should prepare consolidated financial statements. The default presumption, the presence of control, determines the existence of a parent-subsidiary relationship. In the context of Pfrs 10, the quantitative criterion of more than 50% of the voting power was not mentioned but not superseded by a new rule. For practical reasons, the presumption is that ownership of more than 50% of voting power constitutes control in the absence of any evidence to the contrary. However, control also arises from many other sources: statute, contractual arrangements, implicit or explicit control over the board of directors, among others. As Pfrs 10 is based on principles rather than rules, the use of a quantitative criterion is only a guide. This is known as the default presumption. Separate financial statements by a parent, an investor in an associate, or a joint venture in a joint venture in which the investments are accounted for on the basis of the direct equity interest rather than on the basis of the reported results in the net assets of the investees. So in other words, on the basis of the direct equity interest. The investors' separate financial statements reflect the legal interest in the investment and its direct benefits or dividends, rather than the larger economic entitlement share of profits that is brought by control or significant influence or contractual arrangement or joint control. As economic boundaries are enlarged through control or significant influence or contractual arrangement or joint control that an investor possesses over the financial and operating policies of subsidiaries and associates respectively. Another level of reporting is required. This level of reporting is described as the consolidated financial statements that present the financial statements of a group as those of a single economic entity. When the parent acquires a controlling interest in the subsidiary, the parent makes an entry debiting investment in subsidiary and crediting either cash, debt, or stock, or some combination depending on the medium of exchange. Assume that the acquisition relies on a cash purchase price of 500,000. The entry on the parent's books would be okay. So we have now the entry in the parents' books. Okay. Investment in subsidiary and to credit cash. The parent's investment account represents the parent's investment in the different assets and liability accounts of the subsidiary and often includes a significant amount of goodwill. However, it's recorded in a single account entitled investment. The subsidiary, in contrast, continues to keep its detailed books based on historical book values. These values are not as current as the market values assessed by the parent at the date of acquisition, but they are detailed as to classification. The purpose of consolidated statements is to present primarily for the benefit of the owners and creditors of the parent the results of operations and the financial position of a parent company and all its subsidiaries as if the consolidated group were a single economic entity. Consolidated statements ignore the legal aspects of the separate entities but focus instead on the economic entity under the control of management. The presumption is that most users of financial statements prefer to evaluate the economic entity rather than the legal entity. Thus, the preparation of consolidated statements is an example of focusing on substance rather than form. Now, investments at the date of acquisition. The general principles used to record business combinations effected as asset acquisitions were discussed in Chapter 1. In this chapter and throughout Chapters 3, 4, and 5, we will concentrate on accounting for the acquisition of another company's voting stock. So in chapter 1, we have the uh, business combination as asset acquisitions. Recording investments at cost in the parent's books, the basic guidelines for valuation discussed in chapter 1 pertaining to business combinations apply equally to the acquisition of voting stock in another company. Under the acquisition method, the stock investment is recorded at its cost as measured by the fair value of the consideration given or the consideration received, whichever is more clearly evident. Recall that the consideration given may consist of cash, other assets, debt securities, stock of the acquiring company, any form of asset or a combination of these items. Treatment of acquisition-related direct costs in the separate financial statements or parents' books in acquisition of net assets discussed in Chapter 1, Business Combination, wherein the basis is Pfrs 3. There is no doubt that the acquisition-related direct costs are treated as expenses. The following discussion regarding the treatment of acquisition-related direct costs in the books of parent entity does not affect the computation of goodwill, only the manner of recording such costs in the books of the parent entity. In this chapter, the basis is PES 27. Before the separation of PES 27 and PFRS 10, PFRS 27, uh, 2008, termed as consolidated and separate financial statements. The basis is PFRS 3, wherein any acquisition-related costs are considered as expenses. After the separation of PES 27, separate financial statements, and PFRS 10, consolidated financial statements, there is an argument that the basis of PES 27 is not anymore PFRS 3, and the basis for determination of cost will now be under the general rule of recording cost, which includes direct acquisition cost as part of the investment acquired. On the other hand, only Pfrs 10 can use Pfrs 3 as the basis. So in the process of preparing the consolidated statement, the acquisition-related costs become consolidated expenses through working paper elimination entries. The author believes that there is logic on the basis of applying the general rule in interpreting the definition of cost in PES 27. Despite the logical analysis in interpreting the general rule, the author further believes that the original treatment of acquisition direct cost, whether for business combination or separate or consolidated financial statements, will still be treated as expenses in the books of the parent entity for the following reasons. Now we are talking about the original treatment of acquisition direct cost. Now, 1. To capitalize the acquisition-related direct cost as part of the investment seems to defeat the purpose or substance of the standard, which serves as a guide for consolidation procedures. Even in some cases, stand-alone financial statement would be possible. To illustrate, if cash is used for the acquisition, the investment is recorded at its cash cost. Assume that P Company acquires all 100,000 shares of the common stock of S Company for 5 per share and pays acquisition fees of 30,000. So acquisition-related direct costs are not capitalizable. The entry to record the investment now is to debit retained earnings for the acquisition related expense close to retained earnings since only balance sheet accounts are open. So only balance sheet accounts are open. So we have now to debit the entry here. So we have to credit cash, no? The entry is to credit cash for the payment of acquisition of subsidiary. So we now debit to retained earnings for 30,000 and we credit to cash. Now, for the 5 per share, assume that the company acquires all the 100,000 shares of the common stock of S company for 5 per share. So the entry now will be to debit retained earnings and to credit cash. That will be for the acquisition related expense. And now we have the investment for 500,000 and at the same time credit to cash for 500,000. Now for the entry to record investment item. So it's the amount of 500,000 that is to be recorded. And for the acquisition related cost in the amount of 30,000. So in other words, this time your acquisition related costs are to be closed to retained earnings. We assume that the nominal accounts are already closed and only retained earnings is open. So we now debit to retained earnings and finally credit to cash for the amount of 30,000. Now the explanation is to record acquisition related cost. Now, the author believes that there is logic on the basis of applying the general rule in interpreting the definition of cost. Despite the logical analysis in interpreting the general rule, the author further believes that the original treatment of acquisition direct cost, whether for business combination or separate or consolidated financial statements, will still be treated as expenses in the books. Now we have the negative uh, side of it to capitalize the acquisition related direct cost as part of investment seems to defeat the purpose or substance of the standard, which serves as a guide for consolidation procedures. Even in some cases, standalone financial statements would be possible. So we have now the acquisition related expenses are not capitalized. If the parent records the direct cost as part of the investment in subsidiary, it may be a problem when there will be an impairment test which will reveal the cost, wherein the direct cost is already included and will be included in the impairment. In fact, unrecoverable, and there must be an impairment charge at the parent's level in which the direct cost is included as part of the investment to be impaired, when in the consolidated statements they are not impaired since they will be set up as expense, which would have the effect of bringing the parent's accounting with the impairment of the investment, including the direct cost, in line with what would later appear in the consolidated financial statements. So we have now the repeated acquisition-related direct costs are capitalizable. The entry to record the investment on P company's books will be to debit investment and credit to cash. Now, as noted in paragraph 33 of Pfrs 3, where the business combination occurs by the parent exchanging its equity interest for the equity interest of the former owners, the acquisition date fair value of the acquirer's interest may be more reliably measurable than that of the acquirer's interest. Okay, so here it should be noted. Okay, so let's uh, again consider the acquisition related cost. No, it should be noted that this acquisition related cost may be recorded under two assumptions. That one, we are going to again, that the computation of goodwill or bargain purchase gain under the two assumptions are illustrated under the two assumptions above are still the same. Okay, so we have now the acquirer obtains control by acquiring shares, stock acquisition in the acquiree. At acquisition date, an acquisition analysis is undertaken to determine if there has been any goodwill acquired or a bargain purchase has occurred. The acquirer shall recognize goodwill as of the acquisition date, measured as the excess of 1 over 2 below. The aggregate of the consideration transferred measured in accordance with Pfrs 3, which generally requires acquisition date fair value, in the amount of any non-controlling interest in the acquiree measured in accordance with this Pfrs 3, and in a business combination achieved in stages, the acquisition date fair value of the acquiree's previously held equity interest in the acquiree. So the acquirer shall recognize goodwill measured as the excess of 1 over 2. So 2, the net of the acquisition date amounts of the identifiable assets acquired and the liabilities assumed measured in accordance with Pfrs 3. Where 2 exceeds 1, Pfrs 3 regards the giving rise to a gain on bargain purchase. So that is if number 2 exceeds number 1. There will be goodwill if number 1 exceeds number 2. So goodwill is when number 1 exceeds number 2. But if number 2 exceeds number 1, it's a bargain purchase gain that you have to if number 2 exceeds number 1. The measurement of number 2 had been discussed in Chapter 1. The items included within 1 are discussed in Chapter 1 and in the succeeding discussions below. Okay, so we have now the consolidation of wholly owned subsidiaries. Okay, the consolidation of wholly owned subsidiaries. There is no question of control in a wholly owned subsidiary. There's no control. There's no question of wholly owned subsidiaries. When one company acquires another, the acquiree's fair value is based on the consideration given may be equal, more than, or less than the book value. In case there will be a difference between the fair value of the subsidiary and the book value of the acquiree's net identifiable assets, and this is referred to as allocated excess. Consolidation of partially owned subsidiaries. When a subsidiary is less than 100% owned or partially owned, a problem arises as to the determination and recognition of goodwill and the non-controlling interest. Pfrs 3 allows goodwill and the non-controlling interest in the acquiree at acquisition date to be measured at either full goodwill approach or fair value basis, consistent with the measurement principle for other components of the business combination, or partial goodwill approach or proportional basis of the acquiree's identifiable net assets. Now, full goodwill approach or fair value basis. When non-controlling interests are measured at fair value, we refer to this as the fair value option. Goodwill attributable to non-controlling interest will be recognized in the consolidated financial statements. Under the fair value basis, non-controlling interests comprise three components: share of book value of identifiable net assets of subsidiary, share of fair value book value of identifiable net assets of a subsidiary at acquisition date, and share of goodwill in subsidiary at acquisition date. Under the fair value basis, non-controlling interests are determined with reference to either active market price of equity shares of the subsidiary at acquisition date or other valuation techniques mentioned in Chapter 1. Fair value per share of non-controlling interest may differ from fair value per share of the acquirer because a control premium may be paid by the acquirer. For example, in a takeover bid, an acquirer may pay a 20% premium over market price to gain control of the acquiree. Partial goodwill approach or proportional basis of the acquiree's identifiable net assets. Under this second option, there where non-controlling interests are measured as a proportion of the acquiree's identifiable net assets. Non-controlling interests comprise two components as follows: share of book value of identifiable net assets of subsidiary, and share fair value book value of identifiable net assets of subsidiary at acquisition date. Non-controlling interest, share of goodwill. Non-controlling interest, goodwill is not recognized under the second option or proportional basis. Now, goodwill. The computation of goodwill depends on the options mentioned. Goodwill is an identifiable asset in which its existence is an important motivation for a parent to acquire a subsidiary. Goodwill is a premium that a parent pays to acquire the subsidiary and should be separately recognized as an asset in the consolidated financial statements. The acquirer is required to recognize goodwill acquired in a business combination as an asset. Goodwill under Pfrs 3 may be one of two values depending on the measurement basis for non-controlling interest as of acquisition date. It allows two measurement bases for non-controlling interest. Option 1, if non-controlling interests are measured at full fair value, goodwill recognized in the consolidated financial statements will include non-controlling interest share of goodwill. This is known as full goodwill approach. So that is option number 1 if non-controlling interests are measured at full fair value. Okay, option 2, if non-controlling interests are measured at a proportionate share of the value of the net identifiable assets acquired. Non-controlling interest share of goodwill is not recognized under this second option. Under Pfrs 3, this is known as partial goodwill approach. So in other words, if non-controlling interests are measured at the proportionate share of the value of the net identifiable assets acquired, non-controlling interest share of goodwill is not recognized under this second option under Pfrs 3, known as partial goodwill approach. Entity economic unit theory. non-controlling interests are deemed to be as important as a stakeholder of the combined entity, similar to the majority stockholders. The distinction between the parent and the non-controlling interest both are included in the equity. Hence, the entity theory requires a consistent accounting treatment for both parent and non-controlling interest. Under the entity theory, the consolidated financial statements should be prepared and presented for the benefit of both groups of equity holders. Non-controlling interests are shown as equity in the balance sheet. The accounting equation will be for consolidated equity, controlling and non-controlling interest equals consolidated assets minus consolidated liabilities. So for the entity theory, the implicit consolidation theory underlying Pfrs 3, developments in accounting standards underscore an evolutionary shift towards entity theory. Pfrs 3 permits the recognition of non-controlling interest share of goodwill. Under the entity theory, the fair values of assets and liabilities of subsidiaries at the date of acquisition should be reported in full to reflect the stakes of both parent subsidiary, parent company and non-controlling shareholders in the net assets of subsidiaries. Consistent accounting treatment is applied to both parents and non-controlling shareholders' interest in the net assets of subsidiary. Hence, if the assets and liabilities of an acquired subsidiary are shown at fair values at the date of acquisition, non-controlling interests are also deemed to have a share of the fair value increment arising from the revaluation of net assets to fair value. Goodwill is an asset of the economic unit and should be reflected in full. Internally generated goodwill that is not evidenced by an exchange transaction is recognized in full as of the date of acquisition. So, as of the date, net profit of subsidiary should be reported in full as accounting to both majority and non-controlling shareholders. Non-controlling interest share of current profit is not shown as a deduction of profit. Essentially, the differences between the two theories are summarized, okay? So we have now the parent theory, entity theory, attributes the fair value differences in relation to identifiable assets and liabilities at the date of acquisition. Under the parent theory, recognized only in respect to parent share. So for the fair value differences, for the entity theory, recognized in full, reflecting both parents and non-controlling interest share of the fair value adjustments. Next, presentation of non-controlling interest, parent neither as equity or debt, and entity as part of equity. Goodwill. Goodwill is parent's asset. Goodwill is an entity asset and should be recognized in full as at the date of acquisition. Illustration 2-1, fair value of the non-controlling interest in subsidiary not given. Par company acquires 80% of Sun Company for 10 million, carrying value of Sun Company's net assets at time of acquisition being 6 million. That's the carrying value or the book value of Sun's net assets, and fair value of this identifiable net assets being 8 million. The following computations for goodwill and non-controlling interest under two options, proportionate basis, partial goodwill approach. So partial goodwill, we have the consideration transferred in the amount of 10 million. So we have now the book value of stockholders' equity, net assets, Sun Company for 6 million multiplied by 80%. So 4,800,000. So we have now the allocated excess of 5.2 million, and we have now the over undervaluation of assets and liabilities. That's 2 million times 80%. So 1.6 million the positive excess, and that's goodwill equal to 3.6 million. So under proportionate basis partial goodwill approach. So we have now the amount of adjustments to reflect fair value under overvaluation of assets for 2 million. And then the fair value of stockholders' equity of subsidiary, that's equal to 8 million times 20% equals uh, 1.6 million for the non-controlling interest. Now, for the fair value basis or full goodwill approach, the consideration transferred is 10 million divided by 80%. So, meaning the gross is 12.5 million, then the book value is 6 million. We have now the allocated excess of 6.5 million, the over undervaluation of assets of 2 million. We have now the positive excess as goodwill of 4.5 million, and the controlling interest on 4 full goodwill of 4,600,000, and we now get 80% or 3.6 million. We have down the non-controlling interest on full goodwill equal to 900,000. So the non-controlling interest partial of 1.6 million, then we have to add the non-controlling interest on full goodwill equal to 900,000. The non-controlling interest is 2.5 million. So we have now the control premium or control discount. A control premium is an amount that a buyer is usually willing to pay over the current market price of a publicly traded company. Publicly traded company. Ay, sadya. Okay, is usually justified by the expected synergies such as the expected increase in cash flow resulting from cost savings and revenue enhancements achievable in the merger or consolidation. If the consideration transferred is proportionally more than the fair value of the non-controlling interest, there is a control premium. In the opposite situation, a control discount, which often arises in a fire sale or discount for lack of control, sometimes called a non-controlling interest discount, arises. Illustration 1 does 2 fair value of non-controlling interest in subsidiary given with control premium. Sun Company has 40% of each share publicly traded on an exchange. Pluto Company purchased the 60% non-publicly traded shares in one transaction, paying 6.3 million. Based on the trading price of the shares of Sun Company at the date of gaining control at the fair value of 4 million, assigned to the 40% non-controlling interest or fair value of non-controlling interest, indicating that Sun Company has paid a control premium of 300,000. A fair value of Sun Company's identifiable net assets is 7 million and carrying value of 5 million. The following computations for goodwill and non-controlling interest under three options are as follows. Proportionate basis partial goodwill approach. So for the partial goodwill, we have now the consideration transferred 6.3 million, book value of stockholders' equity or net assets equal to 60% of 5 million. That's the carrying value of the net assets. So 3 million, we have the difference of 3.3 million, the allocated excess. Then we have to deduct the undervaluation, overvaluation of assets. If we have 7 million as the fair value, and we have 5 million as the carrying value, so we have 2 million times 60%, 1.2 million for the positive excess or goodwill. That's equal to 2.1 million. So we have now 2.1 million for the difference here. So we have the difference of 3.3 million. That's for the allocated excess, and we deducted the amount of 2 million times 60%, 1.2 million. So we have a difference of 2.1 million. Now, for the overvaluation of assets and liabilities. So, book value of stockholders' equity, 5 million. Adjustments amounting to 2 million. Fair value of stockholders' equity, total of 7 million. Then you multiply it by 40%. 2.8 million for the non-controlling interest. So the fair value or the full goodwill approach, so we now have the consideration transferred for 6.3 million, and we have cash of 4 million, the total of 10.3 million. Then we have the book value of the net assets equal to 5 million. So difference is the allocated excess of 5.3 million, the over undervaluation of assets of 2 million. Now we have goodwill as the positive excess. So we have now the controlling interest in the partial goodwill was 1.2 million. Now, assuming the price paid amounted to 6,294,000, including control premium of 294,000 with no fair value of non-controlling interest given, the following computations based on this assumption are as follows. So we have for full goodwill, 294,000. So we have 6,294,000. A consideration transferred actually originally was 10 million. Then we have 294,000. The fair value of the consideration is we have now 10,294,000, and then we deduct the book value of the stockholders' equity of 5 million. So we have now the allocated excess in the amount of 5,294,000. So we have now the full goodwill 5,294,000. We have now 3,294,000. We deduct the share of the controlling interest equal to 2,094,000. Now we have the non-controlling interest, full goodwill in the amount of 1.2 million. In September 1, 2024, Pear Company acquires 75%, 750,000 shares of Sari Company for 7.5 million, 10 per share. In the period around the acquisition date, Sari Company shares are trading at around 8 per share. Pari Company pays a premium over market because of the synergies it believes it will get. If therefore reasonable to conclude that the fair value of Saris as a whole may not be 10 million, in fact, an independent valuation shows that the value of Sari Company is 9.7 million fair value, assuming that the fair value of the net assets acquired is 8 million, the carrying value is 6 million. So we have now the consideration transferred 7.5 million at 75%. Then we have the book value of the net assets acquired equal to 6 million multiplied by 75% or 4.5 million. So we have now the allocated excess of 3 million, the overvaluation of assets and liabilities in the amount of 2 million times 75%. We have now the positive goodwill that's equal to 1.5 million. Now the fair value basis, full goodwill approach, we have now the fair value of your subsidiary is 9.7 million, then deduct the book value of 6 million, we have 3.7, then we have the over and under valuation of assets, we have now the positive excess of 1.7 million, and the controlling interest on full goodwill, so we have now the NCI on full goodwill of 200,000. Now, control achieved in two or more transactions, step acquisition, business combinations achieved in stages. Business combination occurs when the acquirer obtains control of the acquiree. It is at that date of the second acquisition of shares that the business combination occurs. It is referred to as business combination achieved in stages, sometimes called step acquisition. Obviously, there may be a number of step purchases in the acquiree prior to obtaining control. Control achieved in two or more transactions or source. Okay, so we have now Pfrs 9 with 15%, PAS 28 and Pfrs 11 35%, and PAS 27, Pfrs 10 75%. From 0 passive to 20% significant influence or joint control, and control up to 100%. Step acquisition, fair value of non-controlling interest of the acquiree, subsidiary, and fair value of any previously held equity interest in the acquiree. A Paris company acquires 15% of Syrup Company's common stock for 500,000 cash and carries the investment as an fair value through other comprehensive income investment. Few months later, Perez purchased another 60% of Syrup Company's stock for 2,160,000. At that date, Syrup Company's reports identifiable assets with a book value of 3.9 million and a fair value of 5.1 million, and thus liabilities with a book value and fair value of 1.9 million. The fair value of the 25% non-controlling interest in Syrup Company is 90 900,000. The following computations for goodwill and non-controlling interest under two options are as follows. Proportionate basis, a partial goodwill approach. So we have now the consideration transferred of 2,160,000 for 60 percent interest, fair value of previously held equity, 2,160,000 divided by 60%. So 3,600,000 we multiply by 15 percent. So that will now give us uh, 540,000. The fair value of your subsidiary is 2,700,000 for 75%. So the book value of stockholders' equity, 3.9 million minus 1.9 million times 75%. So we have now the allocated excess of 1.2 million. Then we have the under overvaluation of assets of 3.9 million minus 1.9 million times 75%. So 900,000. So we have now the positive excess for goodwill of 300,000. Okay? Stop anay Nick. Basta lang ko diho. Tanda ilang. Stop anay. Sino pangita ya? Oh, sige. Okay, class. Now, there are still so many slides left. So, what I am going to do is share screen ko na lang ang remaining slides. And I hope you will just record it, no? Or just have it in your uh, cellphone. Okay lang. So, bali ma-share screen lang ako. So, the rest of this remaining, there's still a lot, no? There's still a lot of slides. And so, I hope you will consider recording through the share screen data. Okay? So, I will begin with the next slide. Okay, di na i-share